you everyone for joining our Water Cooler Wednesday. Today we have a very special guest. We have Stacey Ferris. She's a forensic accountant and a professor at the University of Maryland. She is here to help us dissect the FASB recent board decisions from FASB on crypto assets. So just to be clear, none of this is formal guidance. Nothing is set in stone, but they have started to indicate kind of the direction that they're going to be going towards with regards to the business use cases of crypto assets and the accounting treatment of crypto assets within businesses. So anything from requirements on disclosures to reconciliation requirements and things like that. So I'll have Stacey just do a quick intro on herself, and then we'll get started. So welcome, Stacey.
Thanks, Taylor. Stacey Ferris, CPA, CFE, the classic forensic accountant combo. I've been doing that for 10 years. About 6 years ago, got into crypto, both by just self-investing and then just gobbling up every educational resource I could find, wanted to learn more, very interested in it. And that's only gotten more intense as time goes on. I'm very passionate about the area. I think it's very significant it's going to be a very significant part of our economy going forward. I think it's like basically the way the internet grows here going forward. But and so I have developed the ability to give at least 15 straight hours of lecture on this topic at this point.
We'll just take one of those hours from you.
We're gonna try to just take like 30 minutes of me talking. You know, so you have been warned if I start lecturing. Okay. Right. So there's been some really interesting developments. To give a little history on this for anyone who's kind of walking into this and going, I'm not really sure, like, where are we? What's going on? There was not an accounting standard. There still is not an accounting standard, like a GAAP, US GAAP. Here's how you account for digital assets, right? In 2019, the AICPA established the Digital Assets Working Group. And the digital assets, I like to call them DOG for short. And they said, we think that's a cool acronym, but it's not official. So unofficially DOG. They issued a practice aid, and the practice aid was set up in a question and answer format. And for, you know, if you're not a broker dealer, you're just a company that's a filing entity, public or private, right? What you need to do with your crypto is record it at historical cost, less impairments. They basically came out, their first question says, well, what is crypto? Is it cash? Is it cash equivalents? Is it a financial instrument? And their decision was, it's none of these things. And the closest that we can come up with that it is that it is an indefinite lived intangible asset. And by the way, we are talking about, thinking about the hierarchy and all that, we're talking about fungible crypto assets. So not NFTs, not thinking about NFTs, that's a separate category. The accounting for them is a little different. All of this work has been around fungible crypto assets. So the Bitcoin, the Ether, the Doge, anything that's a coin that you would trade, and it kind of acts like money in a way, but it's not money. So AICPA gave us that guide, right? And it essentially said, yeah, historical cost less impairments, right? 2019. In 2020, people started to implement that. In 2021, we saw some crazy action happening, right? So the market goes, here's how the market went. 2020, we had a little bit up, and then we had a down. And then 2021, we had that huge bull run. And then 2022, Terra Luna collapsed. Everything's just crashed, right? In the good year, 2021, the good year for cryptocurrency, MicroStrategy, my favorite example of this, they now have about they purchased in total around $3.5 billion worth of Bitcoin. In the good year, 2021, they took almost $1 billion of impairment loss in a good year. So we have yet to see what the 22 financial statements look like and how much more they would take as an impairment loss, but that's all getting cut short at this point.
Mm-hmm.
Now, I don't know what they're going to show in their 22 financial statements. I think that FASB's decisions, which we're going to talk about right now, are going to, well, let's just say some audit teams are going to be working a little overtime on this, right? So FASB came out in December 14th, 2022, and they said, look, you can't impair, you can't impair this stuff. And they didn't say that directly, but they basically have given us guidance for how to account for this stuff. And they say, we want you to do fair value accounting. So when you say fair value accounting, most of us are going to think, oh, mark to market, kind of like stocks in a way where I might, or an investment where I might show an unrealized gain or loss, right? But this is different. So for crypto, what they're saying is you need to record it and show it on your financial statements at historical cost. And then when you buy or sell it, then you can recognize the gain or loss associated with that. So no unrealized gain or loss recognized in income. Mm-hmm. What's even more interesting is that they have said you don't need to disclose any unrealized gain or loss. That is great for, like, if you want to talk about a signal that they think crypto is going to be a significant part of, like, you know, the fungible economy in the future. They've effectively said, like, they're basically telling you, treat this as kind of like a cash equivalent. And that's not their official words, right? And that's not an official definition, but it is very, very similar, right? For a foreign currency, you don't report unrealized gain or loss. You report the value that you have, and you report what its value is in your reporting currency as of a given date. So they're moving towards fair value accounting, right? What that means, and what Jeff's post today, which I was like, wait, how is it that he's posting about the FASB and I can't find any of the documents, right? Well, so the FASB had a meeting this morning, and they're having a discussion about how do we transition people into fair value accounting? What are approved methods for doing that, right? So they've come up with 3 methods, and what that means, what they're discussing is, we have companies out here who have recognized billions of dollars of losses, of impairment losses, and they're going to have to either restate that going back multiple years, or recognize a gain on their 2022 or 23 financial statements. I think there's, and then there's a third method, but slipping.
The third method, I just pulled it up, is recognize a cumulative effect adjustment to retained earnings or other components of equity or net assets. The adjustments would equal the difference between the previous end of year's carrying amount versus fair value as of the beginning of the current annual reporting period.
So essentially, you know, what they might be, and I don't know where if there's wiggle room for this, it might be that you can mark it up to whatever the current fair value, market value is as of 12/31, and then you got to stick with that. Or potentially you can take it back to historical cost, right? And I think maybe companies are going to kind of look at those 3 methods and say, what makes the most financial sense for us? What's going to work the best with our accounting strategy, right? So that's a decision that has to be made. Now, interestingly enough, and I'm going to walk you through what are some of the disclosures that are required. So the board has said that you need to make some certain disclosures on any significant crypto asset holdings, but they don't define significant. So I spent some time looking this up, looking at other standards, looking at other releases, and looking at, you know, what does significant mean in FASB speak, right? And they never define it anywhere, okay? But generally in application, that's going to mean about 10%. Okay, 10% usually acts as a bit of a threshold. So if you have, and that could be 10% of what, right? It could be 10% of total sales. It could be 10% of total assets, 10% of, you know, market cap potentially. Essentially, you're going to have to look at it and say, like, what constitutes significant? How are we determining that? And then you're going to put that in your disclosure. We determined this is significant because here's why we determined this is a significant amount of this crypto asset. You can't say cryptocurrency, by the way. It is not currency unless you're talking about taxes, and then it's virtual currency.
Yeah.
so you have to make this determination looking at your portfolio of what is a significant holding by itself, each standalone coin that's a significant holding. If it's significant, there's some very specific disclosures. You got to name the asset, its fair value, the units held, and the cost basis. And you're going to have to also disclose how are you doing, like basically your tax accounting for it. Are you doing FIFO, LIFO, etc.? How are you determining cost basis so that you can determine that realized gain or loss when that happens, right? Now, for all the other assets that you have, all the other crypto assets that are not individually significant, you can group them all together and disclose them as a group, right? For entities that are holding a lot of crypto assets, you might want to take some of the categories that are in the crypto asset hierarchy, right? And use those in order to make those groupings. Like, for instance, you have significant holdings in stable coins, right? And so maybe you want to group your stable coins together and put that in your disclosure as a separate category. Significant holdings in wrapped tokens or some kind of DeFi instrument, or you have like Bitcoin futures, right, that you're holding. That's kind of a different asset from, say, holding Ethereum or Ethereum Classic or something like that, right? So making those considerations of the type of asset and how to group them, how to disclose them, I think is part of your accounting discussions and accounting strategy.
One thing I'd love for you to touch on, Stacey, sorry to interrupt, is I know that they talked about year-end reconciliations for crypto wallets as well. Do you mind touching on that a little bit?
I was about to roll right into it.
Perfect. Sorry. Yeah, cutting your flow.
So the FASB has decided to require that there is at least an annual roll forward of crypto assets. Okay, so and that's a reconciliation. This is something that accountants were super familiar with. This, we're talking about the bank reconciliation type thing: beginning balance, ending balance, total activity, total ins, total outs. And essentially what you're doing is saying, I start with my beginning balance, I add all my ins, I subtract all my outs, I should get the ending balance. If I don't, let me find what are the things that are causing those differences, right? And that's basically to make sure you have a good grasp on your activity and your ending balance is correct based on that activity, right? For most, this is really simple to do if you're using something like, well, I take it back. It's not necessarily really simple, but there are tools out there that can make this a lot easier. For instance, crypto tax calculator or other tax calculator tools online. I did this for myself with my own wallets, right? And I found that it shows me my beginning balances in a coin, the ending balances in a coin, and then it pulls in every transaction during the year and gives me summaries by different coins. So you have all the information you need if you're using one of those tools that does the crypto, like the back end crypto accounting or sorting things and so forth. You have all the tools you need in order to fairly easily pull this reconciliation together. But you're going to be required to do it. And it's probably going to be subject to audit as well.
Some of those tools have reconciliation features. I know Crypto Tax Calculator does as well, where it'll show you at what transaction your balance went negative, for example, which can't happen obviously in crypto. So there must be some sort of misclassification or something like that. So some of these tools are now coming out with reconciliation features that help you asset by asset determine where the discrepancy is starting so that you can better identify it.
Yeah, I've seen that on mine. It showed that I had a negative balance at periods, and I was just like, no, the balance was never
negative. Can't happen. Yeah,
so, yeah. I don't fully understand how that happens or why it shows that, but obviously, whatever you pull from any tool, review it, make sure it's accurate, make sure it's correct. A lot of these things are brand new tools. They haven't been, tried and tested extensively. So, trust but verify, right?
Exactly. That's our motto.
Right. So beyond that, the FASB is saying that, at interim and annual periods, you also need to disclose any restricted crypto assets. For exchanges, topic of the year, you need to disclose if you have assets that you are holding that are customer deposits, Or if you have any other crypto assets that are restricted for use, you need to disclose what those are, why they're restricted from sale, the nature and the remaining duration of the restriction, and any circumstances that could cause that restriction to expire or to lapse. So full disclosure, very comprehensive. I think that restricted crypto asset, what's going to fall under that, I think what we're going to see is that's going to become a category for exchanges or anyone who is custodying assets, is they're going to have to disclose, like, these are where we hold our customer deposits, and they are segregated and separate and protected. And I think that a lot of people are going to be looking for that. If you're auditing a crypto firm, you need to be looking for that disclosure and for that safeguard set up in their accounts.
I think above and beyond the requirements from regulations, I think that you're going to see just investors in general start to demand that types of transparency from decentralized exchanges, just because I think people are done with the bullshit and done with if you're going to lend. If you're going to offer lending or borrowing, you need to be transparent with what's happening with those funds. And Binance, I just posted about it, was caught commingling collateral assets with customer assets. And it's like, they said, oh, we made a mistake. And I heard it on the Unchained podcast. And I love Laura Shin, but in this case, she was like, oh, Binance's accounting error. That's not an accounting error. That's an internal controls that's beyond like an accounting error. That's like you were commingling funds, and that should never happen.
Sorry. I think this is where you're going to see a demand for, what's called on-chain accounting. And I've been skeptical of people when they say on-chain accounting in the past, because I'm like, how are you going to get the entire system on-chain, right? Mm-hmm. But where it does make sense is on-chain accounting that shows you, and I was thinking about this yesterday, I was like, God, you know what I'd love to see? I'd love to see it where I can see the balance of the wallet that holds your customer deposits or collateral that they put up, or the wallets. And then I'd love to see like a live tracking. I got 2 lines on there. It's showing me, here's the balance in the wallets and the collateral. Here's the total deposits and all that. And I just want to see it so I can see over time, you're always keeping more in that account, that restricted account, than what you owe out to customers at any one point in time. I mean, that's a perfect world, right? That is like available 24/7 with historical pricing, so that, from an audit perspective or a review perspective, you can look at it. I mean, the whole point of this industry is transparency and decentralization, right? So in being true to that, making this information public and available is almost necessary. When people are, and even in DeFi, for like the DeFi liquidity staking pools, you can, on some platforms, you're able to see the total pool and the activity of it. And I think that just needs to become just standard industry practice for anyone that says they're custodying assets. But I'm getting off topic here, away from FASB update. So the last piece of this update is about disclosures that are not required. And this is going to take some by surprise, right? Not required disclosures include unrealized gains and losses that are still held at the reporting date, which is counter to what a lot of us expected. I think a lot of people expected we were going to see something like similar to stocks or securities, where you report, or some other investment category where you report unrealized gain or loss. Don't need to report that, which means you don't need to track it internally either. I mean, you can if you want for finance purposes or planning purposes, but you don't really have to worry about it. You do not have to disclose the nature or purpose of your crypto asset holdings.
Wow.
You do not have to disclose who holds the cryptographic private key. If it's a third party, if somebody else custodies your assets, you do not have to disclose where you hold them. And fair enough. I mean, and this is why I'm saying they're moving towards treating this like a cash equivalent. Do you disclose your bank account? Like, where do you bank? No, you don't disclose that. The auditors see it, they do their testing, but you don't disclose it.
Well, but the auditors would see it via the bank statements and things like that.
Yeah.
But you mean publicly, like publicly.
Publicly.
Yeah.
You don't have to say who or where you hold your assets, right?
Right.
Not public information. And finally, you don't have to disclose the time of day, time zone, and date the pricing information was obtained to measure an entity's crypto assets. Moreover, they're not requiring you to do something like a point measurement, right? So basically, and fair enough, because most transactions, right? Most transactions are going to come with the point exchange value, right? And that often gets recorded on chain as well. So you don't actually really need to be recording all of that. Like, if it becomes relevant, then you can go back and look at the historical, blockchain based record where it's permanently there. And so I think that's already because that's getting built into blockchains and to the record and transaction records, that you don't have to record that and you don't have to disclose it either. So that's pretty much, in a nutshell, that's what FASB is contemplating. This morning, again, they had a conversation about, how do we get people to transition from the whole impairment regime. I think that NFTs have not been tackled yet, but NFT accounting is probably going to be like, most NFTs, there's an underlying asset for which there's already accounting guidance. So you're going to be looking at that underlying asset. For a lot of NFTs, particularly like digital images and so forth, I think those still will be considered indefinite lived intangible assets. And this is my opinion, by the way. This is not FASB or AICPA. This is my opinion. Right. Those are still indefinite lived intangible assets, right? So those things are still reasonably, in theory, eligible for impairment if the value drops. Of course, the value of NFTs is something that I've been tackling a lot this year. I've had a lot of valuation associations approach me. I've been doing webinars and other training materials around that. And there isn't a lot out there, and it's kind of the Wild West, with people saying, well, I think it's worth $1 million, therefore it's worth $1 million. Or people offering to sell your NFTs to me for, a fraction of a penny so that you can claim a tax loss. And I think that if those NFTs are caught up in an IRS audit or some other kind of dispute, that just because you sold it for a fraction of a penny does not mean that that's going to be accepted as the actual valuation of it. Because on the face of it, if someone's using that to claim a bunch of tax losses, I think that you could get challenged. But that's, again, getting off on another topic, so.
Interesting. I'd love to kind of open up the floor for anyone else to kind of, if anyone else has any questions or input on this. And I also want to make clear that this FASB, and correct me if I'm wrong, Stacey, but this FASB kind of, it's not guidance though. It's all kind of just indicating the direction that they're moving in. It doesn't necessarily set anything out formally. Is that correct?
Yeah, these are board decisions. And so I've put the link into the chat. This is the accounting and disclosure of crypto assets. If you go into this and you expand board decisions section, they don't have any media releases or educational materials. Okay. They haven't made it the easiest to follow their activity. But this is where you can find updates as they roll out. At this point, they said that what they decided this morning at the meeting sounds like they're going to add that piece about how to implement these changes and then open it up in an exposure document for 75 days. Yes. So I'm expecting we'll see an exposure document published at some point in the next, maybe this week, maybe next week. And it'll be open for, 2 months for comment. So guess I have my joy reading material set.
Yeah. Well, thank you so much for the insights on this. I'll give people another moment if anyone wants to ask any questions or contribute to the discussion at all. I know that we still have 14 and a half hours for Stacey here to continue to talk about this, but We'll take her off the hook. No, it's really great to get kind of more of the audit and the accounting perspective, because I know we've been focusing the last couple of calls on more tax related stuff just because it's Q1, it's tax season, but I love to continue to incorporate the accounting and audit side, because it's as big, if not bigger, of an industry for accounting professionals to jump into. And I think it's even less served than the tax side of things, because it's the less obvious side, and it's very interesting with all this stuff and all the developments. So I'll just give it another couple of minutes. I'll announce in the next couple of days what our topic will be for next week. We'll probably do another tax topic, just in the spirit of, oh yeah, sure, go ahead, Tom.
Hey, Stacey, first of all, thanks very much for going through that. I'm just having a look at the website now. I imagine you had to trawl through an awful lot to produce that summary for us. So that's really, really insightful. So thank you for that. I was just going back to some of the things you first said, and maybe it's my, correct me if I'm wrong, basically. So if we're looking at doing fair value accounting, are we saying that if we purchase the asset, we value it at cost, and when it comes to selling the asset, if it's unsold, it's unrealized. If there's an unrealized gain or loss, we obviously can't recognize that. We value it at cost. Is there an argument here to say, well, if we want to recognize those tax losses or gains, we could just sell it at the end of the accounting period and then repurchase it, the following day? Is there any kind of provision in there for that?
No, they're not contemplating people trying to manipulate their cost basis. I mean, obviously for tax purposes, it doesn't work for tax purposes. They're going to go back to your original basis, right?
I think that, I don't know about wash sales in relationship to businesses. I'm not super sharp on that, but yeah, that's an interesting thing. I mean, what would prevent you from doing that? I mean, ultimately, if you sold it, then you would recognize the gain or loss in that period. And then if you happen to pick it up the next day or so, I'm not sure about how wash sale rules relate to businesses.
Okay, so from an audit perspective, right? If I had a client where I see that they're doing, maybe once or twice, I'd be like, unless if it's not material, it's kind of like, all right, pick your battles. They're probably screwing something else up. We'll argue about that, right? But if I see there's like a persistent strategy of they are selling and then buying in order to achieve some kind of a change in their assets, then I would say that's going to raise some red flags, some concern with management of what's your strategy for managing these? Why are you doing this? And potentially it becomes, let's say that if it's a material issue, it has a material impact on the financials, then you got to raise you have to have a more serious conversation about, is this manipulation? Are your financials materially correct? Are you presenting accurate information? I think that's definitely, if it's a pervasive strategy, it's a conversation with management, because it's not accurate information to investors. And that's the point of audit, right?
Yeah.
Particularly for public companies. So if you're manipulating the value of your assets for trying to do some kind of weird buying and selling, like the auditor has an obligation, an ethical obligation to say, this isn't right.
Yeah, 100%.
Yeah.
It feels like the policy doesn't necessarily touch on that, because obviously it's kind of implied that wash trading wouldn't be acceptable. But I'm guessing this is a bit that needs to be stressed to accountants. You may go, oh right, I can do a bit of wash trading here. I can capitalize some tax gains and losses here. But actually, what you said is, I agree with what you said. I think that's correct. You shouldn't be doing that, because that's an ethical question around that. And the auditor is going to test transactions either side of the audit date to make sure that you are presenting the fair and correct value. So I think if you're an accountant, you don't want to be taking advantage of that, because there is no advantage to be taken there.
And I think what you're describing too, there's not an economic substance to that sale, because you're purchasing it right back within a short window. So in effect, you're not really removing yourself from that position in that asset. So Yeah, I normally think of things through the tax perspective, and I'm like, oh yeah, you can recognize the loss, but then from a, you know, presenting the financial statements to the public perspective, it's a different story, right?
Yeah, and I mean some companies like MicroStrategy, if you take the impairment loss and the Bitcoin off of their financials, you get a completely different story when you run financial ratios on the company, the underlying company, less all of the crypto assets, right? Of course, they're the outlier. I love to use them as the example because they have $3 billion worth of Bitcoin on their balance sheet, but yeah, there's an ethical obligation there. And that's what people kind of forget, that auditors are there not just to look at whether or not you're following GAAP, but we also look at, you know, are you being fair in your treatment of different accounting events?
Right.
There's got to be some balance, because if a corporation's duty is to the shareholder, and if taking advantage of wash sale rules puts more on the bottom line and increases shareholder value, you shouldn't have to not do it because it wouldn't look good in the financial statement. So it would probably have to be either some disclosure, or
like once or twice. Again, like they do it, maybe once or twice. They want to reset the value of something, right? I mean, again, you're going to look at what was the effect on the financials, on the accounts. How does this roll up into the financial statements? Is it material? If it's immaterial, then it's a question of, do we need to raise this issue? If they did it once or twice, maybe like I don't know. There's a million different reasons that, or circumstances that could lead to it, right? If it's not material, it may not even get raised, right? If it is material and it's like once or twice, then you probably have a conversation with management going like, so explain to me what you're doing here. Like, what are you doing? What were these transactions for? What was the purpose of them? Do you think you're going to do them again in the future? What was the benefit realized? And you're going to kind of have to use your professional judgment to make a determination of, do we need to disclose this? Is this a material issue? Is management like, screw you, I hate auditors, I'm going to do whatever I want? Then you're like, okay, great. Well, modified opinion.
I'm just thinking of it from a more commercial perspective, and like you say, management, the C-suite team may turn around and go, "Oh, this is an easy and quick win. This rule is kind of left open." And I think that we as accountants in that situation, or as me as the CFO of that company, would have to stand up and say, actually, no, you can't do this, and this is why you shouldn't do this, and this is why you shouldn't do it. I don't know if there's a provision for that in this iteration of the rule, or maybe there'll be something for that, or it may already be something separate that exists for wash trading. But it feels like there should be something in there that kind of makes that clear. And if not, it's maybe a voluntary disclosure that maybe you add to the accounts, or maybe it's something that's stated somewhere that says, we haven't taken part in wash trading. Because I feel like that's almost like something that people are going to try and monopolize on. And this time next year, this rule may well clear up a lot of problems, but if we leave a door open, people are still going to try and walk through it.
Oh yeah, people are definitely going to try to do it. Some people are going to get away with it. Some people are going to get, their hands slapped. For others, the rare one or two, it might actually become a real scandal or something like that. And it might not come up this year. It might come up like they do it a couple of times this year and nothing happens. So then they keep doing it, and then they keep doing it. And then it's like 3 years from now, the auditor looks back and says, hey, hold on a second. And then they make them restate their financials for multiple years. That hurts, right? So, Tom, you're absolutely right when you say CFOs need to think about what's ethical and do the right thing for the companies now.
Yeah, it's an interesting point. I think that, all of this stuff is like, I was on an AMA earlier today, and someone was asking me about whether or not I think that, because we were talking a little bit of NFTs and sales tax, and they were like, well, do you think that, people who have the means to do so are like maybe skirting around sales tax laws by starting up companies in Ireland or places like that, where I don't know if Ireland has sales tax or not, but anyway, some of these jurisdictions that don't have them. And I'm like, I don't know any of them specifically, but I can guarantee you that it's happening. You know, it's like, but is that the way to go? You know, and is that the way for people to operate? So yeah, it's interesting.
I mean, hey, like I said, I want to go back to that. There are different strategies that you implement for the purpose of benefiting the company, and there's good rationale and reason for it, right? What I'm talking about is someone says, oh, I think I found a loophole and I'm going to exploit it for multiple years in order to manipulate the value of my company on the face of my financial statements. You know, it looks like the company's worth this, but when I get into the details of your financials, I find out, oh, you're doing this little transaction here, which has created this effect. You know, that's what I'm talking about. You know, strategic planning, tax planning, you know, opening a corporation in Ireland or having your operations in the Bahamas. There aren't rules against it. You know, sometimes that's the best strategy.
Yeah.
Be strategic, but don't be unethical.
Well, thank you so much, Stacey. I don't know if anyone else has questions. I think I saw Brandon's hand up there. Brandon, do you still have something you wanted to add in?
Yeah, I just had a quick question. Based off of all things considered, when do you think we could really get some guidance from FASB on this? Is this like a this year thing, or?
I think it's a this year thing. I think that you're going to have, we might have a standard by the end of the year. They seem to be moving pretty fast.
Very cool.
Perfect.
It'd be good to have some clarity, because I think that, you know, that would not only bring more people into the space, because, you know, you see a lot of CPA firms don't want to touch it because there's not the clarity there. But yeah, I think it'll normalize the industry a lot more once we get regulations, and I think it'll benefit the retail investors as well, to have more transparency with the rules and regulations. So.
Well, I mean, they have their board decisions out there. If you want to get a head start on things, look at those board decisions and the requirements. That kind of is telling you where they're headed. The distance between the board decision and the final standard is going to be much smaller than the distance between the AICPA's prior guidance and the final standard. So, you know, if you start moving towards what those are indicating, you're going to be a lot closer to the finish line.
Cool. Yeah, that's some good alpha for the people in the community. That's awesome. Cool. Well, I think that's a good time to wrap this up. We can always do follow-up discussions with Stacey when she's available on some of these topics, and as more things come out with the FASB, if she's available. Yeah, thanks again, Stacey, for helping us with this discussion. It's always great having a chat with you.
Thank you, Taylor. I love talking to the
Thanks
company.
so much.
Yeah.
Yeah.
Nothing good to meet
Bye-bye.
you.
Yeah.
Thanks,
Cool.
Stacey. Thanks. Bye.
Have a great night, everyone. Thanks for joining.